Hi, I'm Zach,
I'm Veronica.
and our topic for today is cost of production. Cost of production refers to the total sum of money needed for the production of a particular quantity of output.
Total revenue is the amount a firm receives for the sale of its output.
Total cost is the market value of the inputs a firm uses in production.
Profit is total revenue minus total cost.
Explicit cost is the input costs that require an outlay of money by the firm.
Implicit costs are input costs that do not require an outlay of money by the firm.
Economic profit is the total revenue minus total costs, including both explicit and implicit costs.
Accounting profit is total revenue minus total explicit costs.
Production function is the relationship between the quantity of inputs used to make a good and the quantity of output of that good.
Marginal product is the increase in output that arises from an additional unit of input.
Diminishing marginal product is the property whereby the marginal product of an input declines as the quantity of the input rises.
Fixed costs are costs that do not vary with the quantity of output produced.
Variable costs are costs that vary with the quantity of the output produced.
Average total cost is total cost divided by the quantity of output.
Average fixed cost is fixed cost divided by the quantity.
Average variable cost is variable cost divided by the quantity of output.
Marginal cost is the increase in total cost that arises from an extra unit of production.
Efficient scale is the quantity of output that minimizes average total costs.
Economies of scale, the property whereby long-run average total cost falls as the quantity of the output increases.
Diseconomies of scale, the property whereby long-run average total cost rises as the quantity of output increases.
Constant returns of scale is the property whereby long-run average total cost stays the same as the quantity of output changes.
The goal of the firm is to maximize profit.
When analyzing a firm's behavior, it is important to include all the opportunity costs of production. Some of the opportunity costs are explicit, wages a firm pays its workers. Other opportunity costs are implicit, wages the firm owner gives up by working at the firm rather than taking another job. And economic profit takes both explicit and implicit costs into account, whereas accounting profit considers only explicit costs.
A firm's costs reflect its production process. A typical firm's production function gets flatter as the quantity of an input increases, displaying the property of diminishing marginal product. As a result, a firm's total cost curve gets steeper as the quantity produced rises.
A firm's total costs can be divided into fixed costs and variable costs. Fixed costs are costs that do not change when the firm alters the quantity of output produced. Variable costs are costs that change when the firm alters the quantity of output produced.
When analyzing firm behavior, it is often useful to graph average total cost and marginal cost. For a typical firm, marginal cost rises with the quantity of output. Average total cost first falls as output increases and then rises as output increases further. The marginal cost curve always crosses the average total cost curve at the minimum of average total cost.
From a firm's total cost, two related measures of cost are derived. Average total cost is total cost divided by the quantity of output. Marginal cost is the amount by which total cost rises if output increases by 1 unit.
A firm's costs often depend on the time horizon considered. Many costs are fixed in the short run but variable in the long run. As a result, when the firm changes its level of production, average total cost may rise more in the short run than in the long run. The total cost curve is the relationship between the quantity of output produced and total cost of production.
Positive economic profit of a firm equals stay in business, and this means that the firm is covering all the opportunity costs and has some revenue left to reward the firm owners. Negative economic profit, economic losses of a firm, equals shutdown of business, and this means that the business owners are failing to earn enough revenue to cover all the costs of production.
Profitable business from an economist standpoint, total revenue must exceed all the opportunity costs, both both explicit and implicit.
Opportunity cost is what you give up to get an item and is one of the 10 principles of economics. When referring to a firm's cost of production, economics include all the opportunity costs of making its outputs of goods and services. For example, if you pay $1,000 for flour, that $1,000 is an opportunity cost because you can no longer use that $1,000 on something else.
One example of how economists and accountants analyze a business differently is if someone gives up the opportunity to earn money as a computer programmer, their accountant would not count this as a cost of the cookie business. They wouldn't count this as a cost because it is an implicit cost. No money flows out of the business to pay for the cost, so it never shows up on the accountant's financial statements. However, economists would count this as a cost because it will affect the decisions that this person makes in their cookie business. If this person's wage as a computer programmer was $100 to $500 per hour, they might decide that running a cookie business is too costly. They might choose to shut down the factory so that they can take a job as a programmer.
Meanwhile, 8:01 p.m.
Are you good? Delete it. Hi, I'm Zach.
And I'm Veronica.
Alright.
One eternity later.
Ready?
I really want to hurt picture.
I'm gonna get a sip of my drink real quick. Opportunity costs are explicit. Wages a firm pays its workers. Other opportunity costs are implicit. Wages the firm owner gives up by.
The goal of firms is to maximize profit.
Economies of scale. The property whereby long run.
Go.
Should you start the video?
Diminishing marginal product. Let me read this real quick. Cost of production refers to the total sum of money needed for the product. Opportunity cost is what you give up to get an item, one of the 10 principles of economics. When referring to a firm's economic. Oh, wait.
Wait, you started the video.
Yeah, now I am.
Profitable business from an economic. Accounting profit is total revenue minus explicit costs. Economic profit is total revenue minus explicit costs minus implicit costs. Marginal cost is change in total cost divided by change in quantity. Total cost is fixed cost plus variable costs. Total revenue is price times quantity. Average fixed cost equals fixed cost divided by quantity. Profit is total cost minus total revenue. Average variable cost equals variable cost divided by quantity.